The second laureate that we're going to listen to today is Douglas Diamond. He is author of two of the other papers. So Douglas was born in Chicago and wrote this very important work when he was in grad school at Yale, and he is now back as professor at the University of Chicago. Please, Douglas.
Out of the right mode there. There we go. Well, thank you very much, John. I want to begin by thanking the Royal Swedish Academy for this great honor, and in addition for recognizing this important area of research where I've spent close to 80% of my career trying to understand. So, my clicker starts to work here. So a little bit about how I got interested in this. It's not the kind of thing you just, as a kid, you start thinking, well, how do banks affect the real economy? So it turns out I got interested in economics when I was in college. I went there originally to be a molecular biologist, but then I found economics a bit easier, so I did economics. And I took an amazing and transformational course in my senior year from Jerome Stein at Brown University. And the entire course was a book, one of the best books written in economics by Milton Friedman and Anna Schwartz called A Monetary History of the United States. And there was a very good description and analysis of how monetary policy worked, how exchange rates worked, gold standard and things like that. But the thing that had the biggest impact on me was the discussion of the 1930s in the United States and how there was interaction between monetary policy, lots of bank failures, and in particular lots of bank runs. So that got me interested in thinking about the system, and this clicker is going crazy here. I'm going to use my keyboard instead, lower tech. So my approach to understanding the financial system and the role of financial intermediaries has been, particularly in the two papers I'm going to talk about today, to think about what is special about the mechanism or set of contracts that the financial system writes, and how do those contracts or mechanisms affect the real outcomes on the economy. So what good things do these contracts do, and what potential bad things come out of these contracts? And in the modern economy, these things I'm going to call banks and put quotation marks around them. Banks, because it's shorter than financial intermediaries. Banks could be essentially any institution that writes the contracts that I'm going to talk about. You don't have to have a commercial bank charter. You don't have to have your ability to pay bills or write checks on the outcomes. So these could be many other institutions, which I'll talk about in a minute. Ben actually mentioned a couple of the institutions. But for now, just think Lehman Brothers isn't a commercial bank, but Lehman Brothers definitely fits both the models I'm going to talk about. So the first paper from my doctoral dissertation is called Financial Intermediation and Delegated Monitoring. And it asks the question, what's the best way to set up a mechanism, a firm, that monitors borrowers on behalf of other people? So we're going to have business borrowers that need monitoring. We don't want to have everybody in the world monitor, so we're going to get someone to do the monitoring. And the question is, how do we set up contracts to do this? So we're going to think about conflicts of interest in lending. So we're going to think the whole basis of what these intermediaries are doing in this description of the world is that there are certain pre-existing conflicts of interest in lending, which I'll describe. And we can think about what's the best way to resolve these conflicts of interest when we don't use banks. We just write contracts between investors and borrowers. And what's the best way to do it with banks? So there are going to be conflicts of interest between investors and borrowers that are just always present, but we could bring in a third party called a delegated monitor, which will turn out to be a bank. So then we're going to have three conflicts of interest, or three parties who have mutual conflicts of interest: borrowers, lenders, and bankers. So that's the setup. So here's what I call direct finance. This is how you do finance without having any banks involved. There are a bunch of small investors, so we're assuming that it's not like one rich person who does all the lending in the world. So we have a little bit of income distribution here. And you need, say, 10 or 20,000 investors to lend some money, to invest some money into some firms. And that's going to be the end of the story. If these are the only parties to the contracts, how do you make contracts where you overcome the conflicts of interest, which I'll define in a second? The alternative is not doing it the simple way, doing it sort of the indirect way. You stick an intermediary in the center, a bank, a quote-unquote bank, and why and under what circumstances do you do better with contracts that include this middle entity, the financial intermediary? So the small investors invest money or lend money to the bank, and the bank invests money or lends money to the firms or other borrowers who need to borrow money. Okay, so I said there's a conflict of interest. I'd say in finance, there are lots of conflicts of interest, but the most important one is getting the borrower to repay the lender or investor. Because once the money has been passed on to the borrower, they have other maybe better things to do with it than pay the money back. They can invest it in special investments and projects that may or may not be profitable, so you might not have to screen the projects after they make them. They could do more nefarious things, like do a poorly priced deal with their brother-in-law and sort of tunnel money out of the firm, and sort of cooking the books, things like that. So how do we provide incentives to overcome this pre-existing conflict of interest? So I'm going to consider two contracting ways that are very highly stylized versions of stuff we actually do in the world to get a borrower to repay. So the first thing you can do is impose a penalty on the borrower when the borrower doesn't repay. I'm going to call that foreclosure. So I'm going to think of foreclosure on the borrower, taking something away from the borrower, as a penalty. I mean, let's say you don't pay your home mortgage. If you don't pay your home mortgage, the lender at least has the right to take the house away from you. So that gives the lender the right to sell the house, but it probably has a bigger penalty effect on you. Suppose it's a house and you have children. The house gets taken away, your children will have to go to another school district, all kinds of stress in your family will occur. So we'll think of that as a penalty. So in the really old days, there were penalties like debtors' prisons. So presumably that there's no great joy for a lender of sending the borrower to debtor's prison, but the fact that you might go to debtor's prison would increase the incentive of the borrower to repay in the first place. So the first technology is this thing, foreclosure. The good news is it makes the borrower pay. The bad news is when you actually impose that foreclosure or penalty, it's tremendously inefficient. You really don't want to be doing that very often. And there are huge upfront costs from writing contracts that use that very often. The second thing you can do is the lender, or lenders, each lender, could continuously monitor what's going on in the business to make sure that these conflicts of interest about doing the wrong investment or cooking the books or lending money to your brother-in-law, to make sure those things don't happen. And once you've made sure those things don't happen, you can get the borrower to repay you without this threat or act of actual foreclosure, without actually throwing them into debtor's prison. So you can monitor, then you don't have to impose this inefficient penalty, but it's costly. It takes, you have to take a lot of time and resources to continuously monitor the borrower. You incur these fairly large costs up front, but the large upfront costs are worth it in saving the inefficient foreclosure. So suppose you weren't going to monitor at all. If you don't monitor at all, it turns out if you have these two penalties, the best thing is to use the first one, the foreclosure or the penalty, and you only impose this penalty for small payments. Obviously, you want big payments. You don't want to punish big payments. So it turns out if you just say, what's the optimal financial contract in the set of all financial contracts, the optimal financial contract here is a debt contract where you specify an amount, says, pay me this amount. You can pay me more if you wish, but you won't. Pay me this amount, and if you pay me this amount, I won't foreclose. Pay me any amount less, I will. That turns out to be, in the setup I have here, the best possible contract. The good news is the borrower will repay whenever the borrower can. So this is like 80 years in debtor's prison. You're going to pay that 500 euros, no question about it. But if you owe 500 euros and you only have 200, off to debtor's prison you go, which is not a great place and not a very efficient thing to do. So this is not going to be a problem if the borrower could always repay. If you knew you owed 500 euros, you always had 500 euros, not a problem. But if you only had 200 and you owed 500, it would be a bad situation. So let's imagine there's some uncertainty in how much the borrower can actually repay. Okay, so here's just a super simple example. So you lend some money to a firm, and you lend them some upfront money. Like you lend like 1.1, let's say these are millions of euros, 1.1 million euros, and his or her project, the firm's project, will either produce 2 million euros or it'll produce 1 million euro. And imagine the odds are 50-50, so the probability of each of those is a half. Well, in that case, if you need to get the borrower to pay you back 1.1, which I'm assuming, you're going to have to impose this foreclosure or liquidation half the time, right? Because the borrower can never pay more than 1 when that's all the cash the borrower has. Some of the times the borrower has 2, other times the borrower has only 1. So if you wrote this contract that says, pay me 1.1 or I liquidate, I take your house away from you, you're going to take the house away or liquidate 50% of the time, and that's pretty bad. That would be likely, if it was very inefficient to do that, that would either cause tremendously expensive credit, like Ben was just describing, or it might even be the case that you couldn't possibly raise credit because the lender would get so little half the time they wouldn't be willing to lend to you in the first place. Now, the average value of the cash the borrower actually has, the expected value is 1.5, half of 2 plus half of 1. If the borrower always had 1.5, then debt contracts enforced by foreclosure would work perfectly. Say, pay me 1.1, well, I always have 1.5. So nothing inefficient would actually happen. Threats to inefficient stuff would happen, but actual inefficient stuff would never happen. So again, how do you get the borrower to repay without monitoring? Use debt with foreclosure. But as I just said, if the borrower has to pay more than 1, we have to foreclose inefficiently half the time, and the borrower gets less than 1 in that case. So imagine you got 0 in that case. Well, if you got 0 whenever you could, the half time you couldn't pay, the borrower would get at most 2 half the time and exactly 0 the other half. So if the lender is requiring a 1.1 expected return, in this case, the lender would not be willing to lend to you. So the best contract without monitoring is debt with foreclosure or debt with penalties. It works well if the borrower doesn't have any volatility in how much they can repay you. Works really poorly if there's a lot of volatility or uncertainty. Okay, so that's what we say about unmonitored debt. Suppose you monitor. Well, if you monitor, it maybe costs something up front, but then when the borrower has 2, you can collect up to 2. When the borrower has 1, you can take the entire 1 without this inefficient foreclosure and stuff like that. So if you had somehow monitored, you could do way better. You could write a much better, much more efficient contract than the one I just described. Okay, so that's the good news. If you just monitor, you can save all of these inefficient foreclosure costs. So monitoring, which could be find out what the actual cash flow is and renegotiate bond covenants, making sure they're not stealing the money, making sure the brother-in-law is not doing contracts, all of those things, it avoids the need for these inefficient penalties. Now, I mentioned that there were many small investors here, so we had 10,000 investors in this case. And those things that look like magnifying glasses, those are people monitoring. So if each of the 10,000 investors went there and monitored again and again and again, imagine each investor made a $100 loan and it cost $100 to monitor. That'd be a pretty stupid thing to do, to spend $100 to monitor a $100 loan. So if you have to incur the cost of monitoring 10,000 times over, undelegated monitoring, direct finance with monitoring is going to be too expensive. So if you borrow directly, if you have this direct finance, you borrow from lots of people who don't have €1 million each, you're going to find the best possible contract is going to be an unmonitored debt contract, an unmonitored contract. So if you borrow from directly and there's enough uncertainty about how much you can repay, then you're going to end up finding yourself unable to borrow because the best contract borrowing directly is unmonitored debt, and unmonitored debt doesn't work, and monitored debt is too expensive if you have everybody do it. So then we get, this is the idea about financial intermediation. Instead of having all 10,000 investors monitor, we delegate the monitoring to one party called a banker, and so that intermediary will turn out to be a bank, and we'll see what the optimal contract is to give incentives for this delegated monitoring. It turns out to be something that looks like a lot of bank. So the bank will monitor, the firm will know, and the bank will know exactly what the cash flows are. So the monitoring gets the borrower to repay the bank. The question is, how do we get the bank to repay the investors? So the investors don't see what is monitored by the bank. The bank can see whether or not you're doing a deal with your brother-in-law, but that doesn't tell on the outsiders what you're doing a deal with the brother-in-law. So you could imagine the bank, the brother-in-law, and you could get together if you're the borrower and say, well, yeah, let's just tell them there was only one this period. We're not going to pay them more than that. Okay, so but what will the investors know? They'll know how much the bank actually repays them. Just like before, the borrower would repay the investors or lenders, and if the borrower paid too little, there'd be foreclosure. Do the same thing here. If the bank pays too little, just have the foreclose on the bank failure, the threat of bank failure turns out to provide great incentives for the bank to monitor and to pay. So investors will know how much will be repaid. They can use a bank debt contract. What's the best way to provide incentives for delegated monitoring? Have the bank use a debt contract promising to pay investors. Have the bank fail if they default on it, pay too little. And this will provide incentives for the bank to monitor and to pay investors. If the bank doesn't monitor, the bank won't have enough to pay and avoid the default. If the bank doesn't pay investors, there will be a default. But it turns out for this to work, this is the first key implication of this setup, for this to work, the bank has to be a big bank, has to be large, and it must be diversified. Like if the bank only made one loan, half the time its borrower would only be able to pay one, and that bank would fail with the same probability that the borrower would. So he's like, the banks have to, for this to work, the bank uses these debt contracts, but the bank has to be diversified. What's the diversification doing? Let me take it to the extreme limit, and you can see it here. In my paper and in practice, it doesn't work this well. So I'm going to talk about something called perfect diversification. So suppose the bank makes lots and lots and lots of loans. It's going to turn out that half of them, and let's assume that it's going to for sure turn out that half of them will be borrowers that have two, and the other half will have borrowers that have one. So the expected amount of cash that the bank could collect from the loans is always up to 1.5. Because there's no uncertainty about what the average borrower is going to pay. We just don't know which borrower is going to be the ones that have two, which borrowers that have one. And then we just write a debt contract with the bank. Let's say it has promised payment of 1.1 per borrower. The bank can collect up to 1.5 per borrower, so then the bank never fails. So in the best case, this diversification says, look, we know we have this foreclosure technology, this punishment technology, debtor's prison, just put it on the bank, but because the bank is so much more diversified, it doesn't actually have to ever default, so the bank could issue perfectly safe deposits. If it ever did default, the bad stuff would happen, but it never needs to default because this diversification. And we diversified not to make the asset of the bank safe, we diversified to get rid of the bank's private information, diversified away the bank's private information about how much the average amount it could collect from all of its borrowers. Now, in the real world, and in my paper, we have banks with imperfect diversification. So even if you make lots and lots and lots of loans, stuff happens. So banks are going to fail sometimes. So banks are going to fail if they're small, as they were in the US or in my home state of Illinois until actually quite recently, small, or they're less diversified. They just had one industry or something like that. Or they're a very, very large bank, but they're extremely exposed to macroeconomy-wide risks. So it's important for bank supervisors and regulators to not look at whether their credit standards are good or not. That's an important thing to make sure that they're competent. But you have to look at what's the exposure to the macro risks, like national income, interest rates, wars, that kind of thing. And there's always been a focus on this in supervision and regulation around the world, but post the financial crisis, these things called stress tests explicitly look at how exposed is this particular financial institution to these particular large macro shocks that might bring the whole system down. So that's exactly what this says, is that substantial diversification within a large bank without too much excessive exposure to macro shocks is essential for banking to work well. So a more modern name for this stuff is pooling and tranching. Pooling is just a modern name for diversification. Put loans together in a pool, make a bunch of them. Tranching issues senior claims and junior claims. Senior to the outside, some of the juniors retained on the inside is like a bonus. So it turns out this structure resolves tons of conflicts of interest, more general than delegated monitoring. Peter DiMarzo has a very nice paper on this. Now obviously pooling and tranching, the diversification part of it, the pooling part, doesn't work perfectly, we saw that, and it particularly screws up when the correlation is increased among the losses in the assets. We saw this in the housing crisis of 2007 to 9. So when house prices went down worldwide and in the US in particular, all of a sudden the correlation between mortgage defaults, subprime and other ones, went up. The diversification went away, and we saw mortgage-backed securities become unexpectedly much riskier. Okay, so that's the first paper, the first technology. Second one is a paper with Phil Divig, bank runs, deposit insurance, and liquidity. So there's me and Phil back about 6 months ago. Or no, that was from 1981. We were standing in Grand Teton National Park, and we were happy because we just thought some interesting thoughts about the world. I don't know, maybe something to do with banks, maybe something to do with something else. The very pretty mountains behind us. So once again, this is an idea of how to explain why banks and intermediaries are good to have in the middle and why they use certain financial contracts. So the financial contract we have in mind here is short-term debt. Why do banks use so much, or banks, quote unquote, financial intermediaries, use so much short-term debt to finance long-term illiquid assets, which in turn turns out to leave them subject to bank runs? So why do you choose to write contracts that leave you subject to runs if runs are so bad? Again, so it's a contract structure, mechanism, design approach to thinking about banks. It has nothing to do with banks being money or regulated or part of needing a charter. Okay, so if you hold assets through a bank, you get a better set of things you can get than if you held the bank's assets yourself. So the point of Diamond Divig 83 is that we're going to assume that the bank's assets are long-term, safe if you hold them to maturity, but illiquid. Okay. At one point, we thought about explaining why they're illiquid. We realized, one, that would complicate things, and two, most of the reasons that things are illiquid make our phenomena quite relevant. So we have safe but illiquid. I'll tell you what illiquid is in a minute. Assets, and we show why the liabilities, the deposits of this bank, should be short-term debt and liquid. Okay? So basically we're taking solvency off the table as a reason for bank failures. That's not because it's off the table in practice. We're going to say, look, these banks, if you just hold the assets to maturity, everybody knows they're solvent if you wait long enough. So insolvency is not the reason. We're still going to have bank failures. It's going to be caused by potential runs on the banks, and we'll look at what causes these runs in a second. So we're going to assume that we'll show our definition of what it means to create liquidity. So bank deposits are more liquid than the loans they hold. What that means is that if you hold a bank deposit, you get a higher return for, say, holding it for one period and then getting rid of it quickly, versus holding the underlying bank loan yourself for one period and getting rid of it quickly. So you're buying some insurance against getting out fast. And then that's the first part of our model, that we're going to show that banks could do that. And second thing, we'll show that banks should do that, because investors like liquid assets better than illiquid assets because they don't know how many periods they're going to want to hold them. They might hold them for one period, they might not need it in one period, then they'd hold them for 2 periods. So there's this little bit of risk left, even though these assets are safe if you hold them to maturity. As an individual, you face this risk. You might need to get out early. If you will call an early investor, you might need your money in one period, where maybe you won't. So liquidity is a form of insurance against this early need for funds. So we're going to think, it's not just about paying your bills and thinking like just liquidity is a form of insurance. So here's a super simple example of our model. Here's the illiquid but safe asset that the bank could invest in. Here's one. If this bank, or anybody, you could hold it, the bank could hold it. If anybody invests €1 or 1 unit at date 0, they can either hold it for 2 periods and get 2 out. They hold a maturity. They double their money in that case. Or they can get out in 1 period. They only get 1. So 1 is like, would be way below the present value of 2. So let's not worry about present valuing stuff. If you say, if you hold this asset to maturity, you double your money. If you get out of it early, you destroy half of that value. That's what we mean by it's illiquid. There's a big loss if you get out in a hurry at date 1. And then the bank is going to issue more liquid short-term claims on this. The bank is going to offer you, if you put 1 in at date 0, you get 1.28 at date 1 or 1.81 at date 2. It's your choice. The key thing here, you see in blue, is that if you held the bank asset directly, you'd only get 1 at date 1. If you held the bank deposit, you get 1.28 at date 1. The only thing that's important in this is that 1.28 is a number bigger than 1. All these things I'm about to say are true for any number bigger than 1. So this is sort of, I'll tell you how the bank creates this asset. This is sort of creating liquidity because you're giving people a bigger return over the short horizon period. You have to it's not free, you have to give up something over the long horizon, but it is a form of insurance against the need for liquidity. So just to see how this model works without too many details, suppose there are 100 investors in the world, and we know for sure that 25 of them will need their money early, call them early investors on date 1. The remaining 75 will need their money late, call their late investors. So we know it's 25 and 75, but we don't know, and no one knows yet, who's going to need it early and who's going to need it late. So there's uncertainty about when you're going to need your funding, so you'd like to buy insurance against this uncertainty, insurance against needing your money early. That's exactly what the deposits do in this setup. And I gave you those numbers before. I didn't tell you whether they came out from. Here's where they came from. This is the case where we say, suppose there's not going to be a bank run. Okay, so if there's not a bank run, let's imagine that means the only people who pull their money out of the bank at date 1 are the 25 people who are early and actually need their money. So if 25 people pull their money out at date 1, we give 25 people 1.28, we have to liquidate 32 assets. You can do the math on your own. And that's going to leave just enough assets, or actually a few extra assets, because I did some rounding here, to pay the people who leave their money in until date 2, 1.81. So what I just showed is if everybody is clear there's not going to be a run on this bank, the bank can actually create more liquid deposits out of less liquid assets. We can actually create liquidity here. That turns out to be a good thing. So everybody would be, oh, okay, if this is the set of outcomes that we're going to get, if there's going to be no run, everybody would indeed put their money into the bank at date 1. Get these returns, and only the proper people would take their money out at day 1. The trouble is, if the bank creates liquidity, which is to say it pays more than 1 to the people who take their money out at the early date, at day 1, there's a self-fulfilling prophecy, absolutely for sure, that the bank is going to fail. If people prophesize that prophecy is self-fulfilling. Because look, how does the bank pay the people who take out at date 1 more than 1? They have to liquidate a bigger fraction of the assets than the people withdrawing. So if 25% of the people withdraw, you liquidate 32% of the assets. Well, if 100% of the people withdraw at date 1, you can't liquidate 128% of the assets because you only have 100% to start with. So you can't give 100 borrowers 1.28. You can't even give 79 borrowers 1.28. So if everybody thinks everybody's going to come and ask for their money at day 1, that'll be a bank run, then everybody who predicts that will rush to get their money out of the bank, because if you leave your money in the bank, you're going to get 0 at date 2. Because, okay, oops, it's going crazy here again, but not that crazy. Afraid to touch anything. So if you get there quickly enough at date 1, you'll get 1.28. But if everybody else is going to take their money out at date 1, there'll be nothing left at date 2. So if these are the payoffs, and whether you're early or late, you want to get your money out at date 1. So if a run is expected, the bank will fail. If the bank will fail, that'll cause a run. This is a self-fulfilling prophecy, a Nash equilibrium. So short-term debt runs can bring down a solvent financial intermediary. If you expect a run, you'll want to get out early. And if you think there won't be a run, then you don't want to get out early. So these multiple self-fulfilling prophecies are one way of thinking about why the financial system is sort of by its very nature somewhat unstable. And you would say, okay, let's just get rid of bank runs by making sure the banks don't create any liquidity. Well, that would stop the runs, but it would stop all of the value added of this liquidity creation. So this view of what the financial system is doing in creating liquidity says these problems are sort of hard to fix because you don't want to, quote, throw out the baby with the bathwater, but there are only a few ways of trying to get the best of liquidity creation without having the runs. So one point I like to make whenever I talk in front of non-academics, and for like the last 25 years, except for the word private on there, which I'll tell you why I put it on, private financial crises are everywhere and always due to the problems of short-term debt. So Ben actually just mentions short-term debt runs are what bring down these panics, self-fulfilling prophecy failures. The private sector can cause problems this way. The government has lots of ways to cause problems. So the public financial crises can come from all kinds of things with fiscal policy and things like that. So, and then bank runs are not just about banks. In fact, banks are just one example of the many type of short-term debt financial institutions. Money market mutual funds in both 2008 and in March 2020. Lehman Brothers, we saw that. Stable coins, Terra and Luna. Short-term securitizations called asset-backed commercial paper. All of these things where they're borrowing short and lending long had meltdowns in multiple financial crises, East Asia financial crisis, lots of things like that. So borrow short, lend long, and illiquid, that's the thing. It's not just about fractional reserves in the banking system. We already sort of understood if the bank has to give you currency when you take your money out, and there's not enough currency in the vault for everybody to take their money out, that's the story of George Baker and It's a Wonderful Life. Your money is in Joe's house, it's not back in the vault. Okay, that's true, that will cause bank runs. Everybody says that once their currency is not enough currency, the bank's gonna fail. You don't need to have the right to take currency. It's not just about banks, it's about short-term debt. So how could you stop bank runs? If you have a very solvent government, because we know in the past we've had some issues of governments being concerned about insolvency. If a very solvent government, the government can provide deposit insurance, that'll stop this feedback between how many people you think are gonna withdraw and whether the bank has to liquidate too many assets. We can do lender of last resort as long as you actually do it. The Federal Reserve didn't do it in the 1930s, as it turns out. So no solution is perfect because, actually, as Ben mentioned, this run risk migrates out of the regulated sector. So two optimal contracts in the financial system: pooling and tranching, diversification and issuing senior claims to resolve conflicts of interest, creating liquidity by borrowing short and lending long. These are, I would say, and this is sort of in retrospect, I'm starting this talk, probably 80%, 90% of what the financial system has done in creating new products, and for good or for evil, has been some combination of these two technologies. So this is sort of maybe the financial technology that most stuff has. And you have to understand a new product, you should say, okay, how does it mix these two? Does it use too much of one or the other, or too much of both? And if you see a financial crisis, you got to see if it's a fear of fear itself crisis or not. So the second and regrettably only other paper Phil Dybvig and I wrote in 1986 discusses some implications of this for regulation. If Phil has time, I hope he talks about it. Since then, I won't have time to talk about any of the details of this. Since then, Raghu Rajan, who's up there and back there somewhere, have done some work that links again this short-term debt to financial crises in a way that is consistent with the two things I just said, but introduces all kinds of interesting new channels. So again, the role of financial intermediation is to help resolve conflicts of interest in the world. We add one new idea that turns out to be pretty powerful. Short-term debt is a stronger commitment to pay than long-term debt, especially for financial intermediaries, especially for banks. It's harder to work out outside of bankruptcy than long-term debt, and turns out that adds all kinds of interesting facts and complications. So Raghu, thank you, the very long-term relationship of co-authoring. Here are my remaining co-authors. There's Raghu, there's Yunjahu, who has been on the last 4 years or so, has been writing papers with Raghu and me, and he's part of the long-term team, I hope. Anil Kashyap, Jigwahe, my colleagues at Chicago Booth I've written with recently, and Ro Varecki, who used to be my colleague at Chicago Booth, who sort of helped me learn how to write papers, wrote my first several papers, and those were more about private information and in asset markets. last set of thank yous I have to make are to my thesis advisors when I was in graduate school at Yale. Steve Ross, who was my mentor and basically taught me how to do economics. I think I'd probably still be trying to finish my thesis were it not for Steve. And then my advisors through the whole period, but Steve actually showed up in my third year in graduate school. So I was already working on banking and things like that before I met Steve. And a lot of that had to do with these two advisors, Martin Shubik and James Tobin, who made clear to me in various ways that the financial system was not integrated into the rest of economics in an acceptable way at all. James Tobin, for the macroeconomics, really didn't consider financial markets in proper ways. There's something called the interest rate. There was lots more going on than that. And then Martin Shubik pointed out that the microeconomics of money and banking was like understudied and poorly understood. And the general equilibrium theory, the main thing we would use in most of economics, had no role for any of these. And you could ask it all kinds of questions and it would give you the totally wrong answer. I want to thank my co-authors, I want to thank my advisors, and I want to thank you very much for listening.